Experts are starting to talk about another potential repo market crisis like we saw in September of 2019, which could lead to a liquidity crisis like we saw in the dot-com bust and the GFC.
It looks a lot like Y2K, where the Fed flooded liquidity into the system before Y2K happened, and then they pulled it back, and then you had the tech sell-off. And we're approaching a similar situation.
Could what's happening right now in the financial plumbing lead to another disaster? I'm going to answer that question for you right now in 3 simple, fast steps. Step number 1, let's go over what is happening with the Fed's reverse repo facility. We start with a chart, today's date going all the way back to 2020. On the left, we go from 0 all the way up to $2.8 trillion. And prior to 2020, the reverse repo facility was used a little bit. And then after the surveillance sickness, or during the surveillance sickness, not much, but when the Fed started to increase rates, that's when we saw the utilization for the Fed's reverse repo facility explode higher, where we go from effectively 0 all the way up to almost $2.8 trillion. And I like how these charts always kind of give you the middle finger before they go ahead and collapse, do the old Wile E. Coyote moment. And that takes us to about 2024, where it continues to decline, but it declines at a less rapid rate. And we get to today's date where we've dipped under $100 billion, and that is significant. So a lot of you may be asking right now, okay, George, I get it. Why is this a big deal? Or the experts, why are they arguing this is a big deal? Okay, well, a lot of them would say that all of this cash, this 2.8 trillion that was built up in the reverse repo facility, was just excess cash just sitting there on the sidelines. And when the T-bill rates, in other words, U.S. short-term government debt, got up to a point, well, that would drain all of this cash out of the account. So there was all of this dry powder, basically, that was just sitting there waiting to absorb all of this government debt that was being issued by Janet Yellen. So if this cash is depleted, then who's going to buy the short-term treasuries, the U.S. government debt? There isn't going to be a buyer, or at the very least, demand goes down, so interest rates go up, throwing a big monkey wrench into the financial system, which might require the Fed to come in and do quantitative easing once again. But the buyer of short-term treasuries isn't the only issue. Let's remember, the market thinks, or most experts believe, bank reserves equal liquidity. So the more bank reserves we have on the Fed's balance sheet in the reserve accounts of the big mega banks, then the more dollar liquidity we have. And then, of course, the fewer bank reserves, the less liquidity we have. And a lot of these experts think that the big blow-up we had in the repo market September 19th was a result of a lack of liquidity or a lack of cash. Okay, now that we understand that framework, let's take it a step further. Because the Fed has been doing QT, the opposite of QE, where they've been reducing the size of their balance sheet. They're letting these treasuries mature and roll off their balance sheet. Therefore, if they're not buying more to replace the treasuries that are maturing, they're taking those bank reserves or liquidity out of the system. And you could say the same thing for the TGA. If Janet Yellen, or now Scott Bessent, is increasing the level of the TGA, that would also take reserves out of the accounts of the mega banks. But what has happened is the approximate 2.8 trillion has come out of reverse repo and gone where? Into the reserve accounts for the mega banks. So let's think this through. As the Fed is reducing the amount of bank reserves in the system by doing quantitative tightening, the reverse repo draining is increasing the amount of bank reserves in those accounts that are liabilities of the Fed, that are assets of the mega banks. So you have this situation where the reverse repo account going down is actually offsetting the QT the Fed is doing. So on net balance, the amount of bank reserves stay pretty much the exact same. Or another way to say it is they're not draining liquidity from the system that they otherwise would be if they're just doing quantitative tightening alone without the cash flowing out of the reverse repo account. But now let's think about the next step. If you no longer have the reverse repo account offsetting quantitative tightening and the Fed continues with QT, then you're going to have this continue to go down to a point where we could get to dangerous levels, levels that we saw during the repo spike of September 19th, which almost blew up the entire financial system. Now, I want to be very clear. What I'm doing is I'm explaining the argument from these experts that say this could be a big, big problem. This may or may not be my view. I'm going to reveal exactly what my opinion is in step number 3, so you have to stay tuned to the end of this video. Step number 2. Now let's go over something very mysterious. Why on earth did all this money go into the reverse repo account to begin with, and why has it come out? To try to answer this question, let's start by looking at a chart from Lance Roberts. I believe this is his site, realinvestmentadvice.com. And I'm going to work in, well, no pun intended, reverse order. We're going to start by looking at the decline, and that's represented, or the balance of this account is represented by this green line. So the decline starts, let's say, in the middle of 2023 after we had the big banking blow up with Silicon Valley Bank, First Republic, Credit Suisse, etc. So during this time, you see the interest rate on the 1-month T-bill, which is the red line, go above, substantially above, where the RRP rate was, which is represented by this blue line. So again, the RRP rate is the interest rate the Fed is paying for money parked in this facility. So if you had the T-bill rate go above that, well, then naturally, as you'd expect, all of these managers would take the cash and move it over to T-bills to pocket the additional, let's say, 10, 15, 20 basis points. So this makes a lot of sense. But what makes no sense whatsoever is why the cash funneled into the facility to begin with. So we see this start right in the second half of 2021. And it just goes parabolic until we get to the first part of 2022. Now, in step number 1, I misspoke slightly. Remember, I was saying that the interest rates were increasing, but that was really the second half of this increase, which took the balance from, let's say, 2 trillion up to the almost 2.8 trillion. But the first spike higher was happening when interest rates, the Fed funds rate, was still at 0. Now, the mainstream argument as to why we saw these balances explode in the Fed's reverse repo account was because the money market funds, which represent kind of 95% of the players here, they were just flushed with currency units from stimmy checks, government spending, etc., and they had nowhere to park the cash other than the Fed's balance sheet, which in and of itself doesn't make a lot of sense because they could have just bought T-bills like they always do. So that's the first red flag, if you will. Now, there could be an argument that, well, maybe the reverse repo account back then was higher than what you're getting on T-bills. But if we look at Lance's chart, we can see the red line and the blue line are pretty much identical this entire first run up in the balance of the reverse repo facility. And another thing that doesn't make sense is if we actually look at the amount of money in money market funds during this time, we do not see a spike. Look at this from Q2 of 2021 The next 12 months, we see the amount of money in these funds is pretty much flat. And the reason I'm using this 1 year or 12-month time period is because, again, that's when you see the huge run up or the initial run up in the balance of the reverse repo account. So the main takeaway here is, although there is some explanation as to why the funds are being depleted, in my view, there is no explanation as to why the funds went in there to begin with. There's a lot of pieces of the puzzle missing. So I can assure you, whatever you're hearing as far as an explanation in the mainstream media is completely wrong. Step number 3. So, do I think this is going to lead to a liquidity crisis, or maybe more specifically, a repo market crisis like we saw in September of 2019? Well, my answer may surprise a lot of you, because my base case is no, absolutely not. And I'll tell you why. Let's start with the chart pre-QE. So 2007-ish, 2008, going all the way back to 1940. Now, this chart is going to shock a lot of you. So make sure you're sitting down for this one. I don't want you guys to have a heart attack. On the left, we go from 0 up to $100 billion. Now, you may be asking yourself, George, what does this chart? I don't recognize it. It looks a little bit like a submarine or something. This is actually the bank reserves that were in the system. Remember, this is supposed to be the Fed liquidity spigot. And this is supposedly what the entire monetary system needs to function. And the lack of this equals this, and potentially this. Right? That's the mainstream narrative. That's the argument all these experts are giving you. Well, as you'll see, if we go back in history, the argument is very difficult to back up. So, 1940, the amount of bank reserves in the system, about 10 billion, with a B. Then we fast forward to 1950, we get about maybe 20 or so, and that's very important. More on that in just a moment. And then we get to the 1970s or 1970, and we're right around 30 billion. Now remember, this 1971 is when we went off the gold standard. So no longer were we restrained from printing all this fiat currency, which you would assume would require a lot of the bank reserves at the Fed's at the center of the monetary solar system. But what did we see? From 1970 to 2007, 2008, the amount of bank reserves went up by a whopping 10 billion. And this is the time when we went off the gold standard and had all of this insanity with fiat money printing for the first time. But it gets a lot more interesting. Let me show you what I'm referring to. Remember I talked about 1959. Well, this is an important date. Why? Because it's when the Federal Reserve started including vault cash with the bank reserves. You see, prior to 1959, this red line just represents the amount of electronic reserves. It did not include the vault cash. Now, why is this so important? Because if banks are actually using bank reserves as liquidity, what that would imply is they're using it to settle transactions. Well, I can assure you, JP Morgan, Wells Fargo, Bank of America are not using green pieces of paper, in other words, vault cash, to settle transactions between banks. They're only using those green pieces of paper So if you go to your local branch and say, hey, I want $500 in cash, or you go to the ATM, they've got the cash. But again, for interbank settlement, they're not using green pieces of paper. They're using the electronic reserves. So if we're actually going to get serious about the liquidity supposedly the Fed provides with the bank reserves, we've got to get hyper-focused on the electronic reserves. Notice this black line goes from right around, call it 20 billion or so, in 1959, all the way down to 10 billion. And I'd like to point out, this is the exact same level as we had in 1940. You may be asking yourself, George, what does this black line represent? That's the amount of electronic bank reserves that were on the Fed's balance sheets in the accounts of the mega banks. So what I'm saying here is, if you believe that this is actual liquidity, then you have to believe that the amount of liquidity in the system from 1959 to 2007, 2008 actually went down. Now, any third grader can tell you that's impossible. M2 money supply in 2008 was 7.5 trillion, and that's just in the United States. Globally, the amount of dollars, maybe 30, 40 trillion. That is way, way, way higher, obviously, than it was in 1959. So the punchline is, this doesn't matter for liquidity, because the Fed doesn't create liquidity at the end of the day. It's the commercial banks. The commercial banks create the liquidity for the financial system. And if you need proof, I simply give you the fact that the amount of reserves from 1940 to 2008 didn't change at all. And from 59 to 2008, they actually went down, while the monetary system exploded higher. So again, what that means is the commercial banks themselves are creating all the liquidity they need, regardless of what's happening with the Fed's balance sheet, more specifically, regardless of what's happening with the reverse repo facility. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.